My guest today is Rob Hoffman from BecomeABetterTrader.com. We're talking about what you should trade, and should you trade just one thing and specialize, or trade a lot of different markets? So Rob, should I be an expert at one market, or should I be able to trade other markets depending on what's going on?
Yeah, that's a great question. You know, certainly when you're starting out, starting with one instrument and understanding its characteristics is key to the learning process, because if you're trying to learn too many instruments simultaneously, then you don't yet know whether your system is wrong or your system's wrong for one particular instrument. So being a jack of all trades and master of none is probably not the best way to go about it.
So do I need to have a different system for each market, or can I be watching the same moving averages across different markets and trade the same way?
Yeah, you know, that's a great question, because ideally you'd like your system and methodology to be compatible with multiple instruments, but you're still using the same methodology, because now otherwise if you're using different systems on different instruments, the level of complexities, you don't know whether it's the instrument's behavior that's changed, your system is no longer as valid as it was. So ideally, if you can use the same methodology, the same system across multiple instruments, that would be the ideal situation.
All right, and what about trading the same or different markets with the same day and having multiple trades on across different markets? Is that okay, or should I hold off on that?
Well, holding off, certainly when you're brand new, to try to focus on multiple instruments simultaneously, especially when you're brand new. To put it in perspective, I've been of course trading for many years, teaching traders all over the world. I'm distracted, if you will, in my trading each morning. I'm talking to thousands of traders, going ahead and doing my own trading live on the screen, explaining why I'm doing the trade. And with all that and being able to multitask, I still don't like to have more than two positions on at the same time.
All right, so if I'm a relatively new trader, what 2 or 3 markets should I start with to get my feet wet and really understand those before I move on to others?
Well, what I find, a lot of people tend to lean towards the S&P futures when they first come into the futures business. The reason being is because there's such a plethora of news or information and reading materials out there on the S&P futures. Now, in the last couple of years, that's changed. We're seeing a lot more Forex information out there. We're seeing more on crude oil and gold and other stock index futures, but the abundance is still out there from the old days, if you will, on the S&P futures. So because it seems like there's a lot of people like to get their feet wet in the S&P futures, I don't really have a problem with that. But I would also suspect that it'd be worthwhile to take a look at something like the Russell futures, because the Russell futures, in the same time frame that the S&P futures may move 15 or 20 ticks on the S&P, the Russell sometimes may move 25, 30, 35 plus ticks. And when you take the difference in $10 tick value for the Russell versus $12.50 tick value on the S&P, it still ends up being much more better as far as range and dollar leveling out there, of going ahead and favoring the Russell, actually. So to go ahead and then take some of the things you've learned in a slower mover like the S&P, then apply it to something that's still a stock index future, and then migrate over to something that's a little faster like the Russell, could be a great first fit.
All right, so I should be basically looking at the market that's moving that day, that has a little more volatility. If the S&P doesn't have volatility, I need to be able to find something that does move and be able to trade that successfully.
That's critical, because, Tim, we've gone ahead and in past videos here, we've talked about the whole issue of fear of pulling the trigger, the different types of Tasmanian devil, Superman, lots of different things we've talked about here over the years in these videos that humans, that us as traders, we succumb to. And so what happens is, if you're a one-trick pony, if you're a one-instrument trader, what ends up happening in low volatility periods of time is we tend to go ahead and start forcing trades that we have no business being in, but out of desperation, because this is the one instrument we trade and we have no willingness or comfort level to trade other instruments, we're stuck. So you have two choices: not trade at all and not have a chance of any sort of profit opportunity, or take excessive risk in a low volatility environment with your system and perhaps lose money. And so the better solution would be to actually have a more diversified portfolio of instruments that you look at. So if one particular market's not moving, that you have at least 1 or 2 others you can go to look to see if there may be opportunities.
Rob, thanks for your time.
Thanks for having me, Tim.
You're watching the MoneyShow.com video network.